Welcome, everyone. Today's live thought leader webinar is titled An Abundance of Options, a survey of current alignment trends for physician enterprises. This thought leader webinar is brought to you by Coker Group. The live webinar will last 60 minutes, and at the conclusion, there will be an opportunity for Q&A. To submit your questions, please use the Q&A feature at the bottom left of your Zoom window. Now I will turn the presentation over to our presenter, Justin Chambly.
Thanks, Kristen. Excited to be here with everyone today. The topic, as was mentioned, is an abundance of options, a survey of current alignment trends for physician enterprises. And as you'll see, as we get into the material, we're using the term physician enterprises pretty broadly to cover both private medical groups, hospital-affiliated medical groups, and other medical groups, whether it be tied to disruptors or other ancillary healthcare providers. Just a little bit of background on myself. Justin Chambly, Executive Vice President with Coker Group. I lead our financial services team and spend the majority of my time working with physician enterprises on provider compensation strategies and transaction advisory matters. And I'm excited to be here with you today talking about this topic that is, I think, at the top of many minds in the healthcare industry. And as we think about what we're going to cover in the next 60 minutes, the first thing that we want to look at is just the evolution of alignment, really highlighting the fact that it is not new. It continues to change and evolve, and we can expect this to continue to do so. We'll also dive into the current market, looking at some of the trends that are occurring right now that are impacting alignment, dive into alignment trends specifically, and then move into sort of what we think the future may look like as alignment continues to evolve. So let's just dive in and start with a history lesson and just really look at how alignment has evolved over the years. And we'll start in the 1980s. No need to go back further than that, but we can start in the 1980s and really highlight the fact that, as I mentioned earlier, alignment isn't new. Physicians and hospitals have always had a relationship. That relationship continues to change and evolve. But if we go back to the 1980s, as reimbursement begun to change, as things like the resource-based relative value scale came onto the scene and it affected reimbursement, it started to change the dynamics of hospitals and physicians working together. At the time, the relationships were a little bit more adversarial than collaborative, yet they both saw the need for one another. And as those reimbursement changes started to occur, and as physician-owned healthcare entities begun to develop, that started to initiate the first wave of physician alignment, meaning the threat of competition started to realign the focus of perhaps we can work together in some way. And this really took hold and gained a momentum in the 90s as PHOs and IPAs came online, lots of focus on consolidation in the physician space, and that drove both consolidation outside of hospitals, but also within hospitals. And this era was characterized by high valuations, high provider compensation as part of the employment arrangement, long-term guarantees, and as we ended up seeing, the alignment models did not work. The economics didn't make sense. And in the late 1990s, we saw these plateau and begin to decline, sort of ending that first wave of alignments. But we were not done there. Yes, while we shifted a little bit more to a focus on private practice, the alignment trends continue to evolve. And in the 2000s, as we know, a lot of things changed relative to healthcare. And what we really saw is hospital physician relationships begun to be seen as more symbiotic or transitioning from symbiotic, meaning we're living alongside one another. We recognize the need for one another, but it moved to a term I like, competitive interdependence, meaning we still see the need for one another, but we got to find a way to work together. And, as there was a continued push for things going on in the ambulatory side of the equation, as physicians took hold of that, health systems did not want to lose some of those opportunities that physicians moving into, more into private practice, more advancing their development of ancillaries and other dynamics. They wanted to avoid that. Thus, we saw alignment begin to pick back up, with employment being really a key focus, seeing that occur in the 2010 realm as well. Things that occurred then, we saw an uptick in the need for physician leadership. So it wasn't just a, hey, we want to employ you, but we see benefit in bringing physicians into the leadership fold, taking on dyad leadership roles, and really driving decision-making in a collaborative manner. We saw employment being the key focal point in those early timeframes, yet new forms of alignment, such as professional services agreements, tended to gain momentum. And we saw other things really taking hold as well. With the Affordable Care Act coming into play, value-based reimbursement was a focus, and the idea was, hey, we need to have strength in numbers. We need to work together to truly have an impact on the value-based reimbursement realm. And then as we get into the 2020s, a lot of the same alignment dynamics that we saw pop up in the 2010s continued to take shape. Yet I think we saw those alignment models continue to evolve more, meaning it wasn't just an employment, it was any way that we can align, we'll look at aligning. So a lot more of an open mind as to what alignment may be. But one of the unique things that's happened in the last number of years is new players have come online. And this is one of the key things that we're going to look at over the next hour, is how these new players have affected the alignment realm, meaning private equity investment in healthcare, as well as non-traditional players or disruptors coming in. And really what occurred is private practice physicians and physicians already in hospital employment all of a sudden have a number of options that they did not historically have. And that has started to change the alignment dynamics. You also have health systems who are experiencing more financial pressure than they have in a number of years, and that is affecting how alignment occurs. And so as we look at the last 4 or so decades, what we see is alignment is not a new concept, but with the ever-changing healthcare environment, the alignment models and things that are affecting alignment models continues to change and evolve. And I think we will continue to see that. And if we dive in and just spend a little bit more time looking at the current market, I think it'll help us to understand some of the alignment trends. And I think the best way to really understand the current market is to look at news headlines. And so what I did is went and grabbed some news headlines that were out there on the web over the last number of months. And I think it starts to tell the tale of where we stand from an alignment standpoint. So just a few headlines on this slide highlight some of the ever-changing dynamics. Up in the top left, we see Oak Street Health boosting CVS in the race with Walgreens. As we know, Walgreens has a huge stake in VillageMD, and now, which also includes Summit Health. And so we have what at one time were more or less drugstores who have evolved immensely to where now they are a huge player primarily in the primary care space. But as VillageMD has changed that dynamic with the Summit Health acquisition, it is moving towards more so multi-specialty dynamics as opposed to just primary care. We see private equity continuing to take a foothold in the healthcare space. And we'll look at this in a little bit more detail as we move along. There's a number of varying perspectives as to its impact, meaning is it good, is it bad, what's the end result associated with it. We also see what I would call non-traditional players, the Amazons of the world, getting into the healthcare space, both in the sense that they see an opportunity to make money, yet they also feel like they can have an impact on both quality and cost. And so we see them getting into the fold with One Medical in just one realm of their healthcare play. And then we see news headlines such as what you see sort of in the middle of the page. Has the backlash against physician employment begun? No different than we saw in the 1990s. Are we about to experience a wave of health systems rethinking whether employment is the right approach? Turning the page to some other headlines, focusing more so on hospitals. These headlines don't paint a rosy picture of the current economics for hospitals and health systems. We see things like projected margins being on track to make 2022 the worst year of hospitals. Hospitals sending out distress flares, things that don't sound optimistic as to the current state of health systems and their economic performance. And I experienced this recently with a client of mine. I was participating in their physician leadership committee meetings. And at the start of the meeting, the CEO of the health system went through and was providing sort of an economic update on the health system, looking at the financials over the last 4 or 5 years. And what it really demonstrated is, some revenue growth, but expenses growing at a faster pace than revenue, which is eroding their margins. This is a health system that has tended to perform well financially in the past. And so they are still generating positive margins, but those margins have shrunk such that the free cash flow being put out is not enough to cover their, not their growth capital needs, but their ongoing capital needs in terms of funding regular investment in their current infrastructure. And the CEO is just highlighting that the dynamics have changed, and that is affecting how health systems think about future growth and expansion, who they align with, et cetera. And because of the pressure on the health systems, we are seeing similar questions being asked surrounding the provider enterprise. Once again, headlines from a few news stories over the last several months, looking at the future of the provider enterprise, from loss leader to value generator, medical groups, physician practices hit with high expenses, why it may be time for health systems to restructure their physician enterprises. And so there's questions being asked of, what does the future of a physician enterprise look like? Is how we have thought about it in the past still what the future holds? And so I think the transition, in terms of what we've seen, has been from what we've done over the last 10 years, let's say, of creating critical mass to now focusing on value creation, meaning how do we take what we've created and truly start to drive value from it? And that need to drive value or measure the value associated with the physician enterprise is greater than ever. Just looking at a few more meaningful stats on the current state of affairs. By no means am I going to go through each of these, but I think they highlight the current dynamics. Roughly 75% of physicians are affiliated with a hospital, health system, or corporate entity in some way. There is a growing physician shortage, which we can speak to more. I think one of the unique dynamics right now that we see is health systems are struggling financially. If we look at supply-demand dynamics, the supply of physicians is being far outpaced by the demand, meaning we have an imbalance of supply-demand, which typically would push wages up. We have growing competition in the market in terms of options for physicians that we'll dive into more. So we have this dynamic where supply-demand and competition would infer that wages for physicians are going up, yet the typical payer of those wages does not necessarily have the economics to support it. And so I think the next several years, both in the context of physician alignment, but also provider compensation, are going to be interesting as to how all of these dynamics play out. And so I'm a accountant by training. I like to distill things to math equations where possible. And what we see is financial pressures plus the changing market dynamics, truly require us to rethink the physician enterprise. And I think that's what we see going on in the market, is all of the evolution that we're seeing is driven by this imbalance, or this dynamic of the financial pressures and the changing market dynamics really forcing us to rethink what we've done in the past. So I want to transition a little bit and really look in depth at alignment trends from three perspectives, looking at them from the perspective of new physicians, meaning physicians that are new to the workforce and the alignment options that they have available to them, looking at independent physician enterprises. So this is those physician enterprises, those medical groups who have not pursued alignment yet and what options exist to them, but then also wrapping up the conversation with current hospital affiliated physician enterprises and alignment options that may be available to them over the next number of years. And so if we dive into new physicians, new physicians coming into the practice of medicine obviously have the legacy options that I think have been around for a number of years. And that would be pursuing a solo private practice, joining a private medical group, and becoming a hospital employee. And these legacy options, I think, still are the prevalent or most prevalent and dynamic options. We still see tons of hospital employment. We see health systems looking to grow their provider base through new physicians coming out of training and joining them. We even see an uptick in physicians joining private medical groups and being supported through income guarantees and other matters. And so these options are still very, very prevalent and occur heavily. Yet what we see is this growth in new options that several years ago probably were not as available as they are today. And those include joining a private equity-backed entity or a non-traditional healthcare provider, meaning the VillageMDs, the Privias, the Oak Streets, the other entities that are out there, the One Medical owned by Amazon, et cetera. We see the uptick in locums work being an option, meaning instead of being tied down and being a full-time employee, because of the opportunities out there and the need, I can pursue full-time locums and have a lot more flexibility in my schedule, and perhaps make a premium because of the ability to fill that gap that is needed in certain markets. And then the other option that is truly new is telehealth, meaning I can sit at home, I can in essence meet the needs of patients in a variety of ways through telehealth, as opposed to joining a more traditional medical group. And so all of these options exist, and that is what is truly creating competition for physicians in a very tight labor market. If we look at some of the more traditional alignment options being employment, we see that growth continuing to occur. If you look at the table in the latter part of this slide, the bottom right part of this slide, you can see that employment tends to continue to uptick. But what we see is, especially in that 2021, 2022 timeframe, the uptick is starting to plateau a little bit. And so while hospital employment continues to increase, it is increasing at perhaps not quite the same pace that it did several years prior. And why that is likely due to some of these other entities that are popping up. So this is a slide from a Just Healthcare article from a number of weeks ago, and it's really talking about the uptick in provider employment, highlighting the fact that provider employment continues to increase. Roughly 75%, as we mentioned earlier, of physicians are employed. But what is really interesting is if we look at this gray box, it highlights where physician employment has changed since 2019. And what we see is, yes, as I mentioned, hospital employment continues to grow at a pace of about 11%, which is quite healthy. It's not low at all. But what is striking is corporate employment has increased rapidly. And that's where we see perhaps the dynamics of physician employment by hospitals starting to be balanced out because of all these other entities that are popping up that are creating options for physicians that historically did not occur. And, if we think about why physicians tend to want employment versus, being entrepreneurial in terms of joining a private group or hanging up their own shingle, the key reason is risk aversion, meaning, I want financial security. I want to shift that risk to somebody else. I want to be paid a market-based rate for my work and leave the economic dynamics of healthcare to other parties. And that's what we see availed to physicians in employment arrangements. And so if we think about private physicians or new physicians, I should say, entering the workforce, there are challenges. I mean, private practice is always an option, but it comes with downsides. In essence, in our opinion, if there's not some form of economic support, or for primary care, strong success in risk-based care, or the ability, which we see a lot of specialty care physicians being able to do, to supplement their professional fees with cash-based services or ancillary services, it is hard to make it in the private practice realm. We're working on a number of deals right now where a private practice is fiercely independent. They more or less over the last several years were propped up by provider relief funds tied to COVID. As those economics change, meaning as some of those stimulus payments go away, they're faced with the reality that now exists, and economically they cannot make it, and therefore they are looking for other options. From an opportunity standpoint, as I've mentioned, there's more opportunities and options than ever before for new providers. I think those options will continue to exist. And clearly, we are in a market that favors the physician over the employing entity, meaning the supply-demand dynamics lean in favor of the physician versus the employing entity. And as I mentioned earlier, I think how the economic pressures of those employing entities change will have an impact on provider compensation going forward. And I should have mentioned at the onset, please feel free to drop questions in the Q&A section of the Zoom webinar, and whether it is on an ongoing basis throughout the presentation or at the end, we'll make sure and try to get those answered. So if we turn and look at independent physician enterprises, so these are those medical groups that still have some level of critical mass, they have not aligned with somebody yet. What options do they have? Legacy options continue to be there, meaning remaining private, affiliating or selling to a hospital. Those historically over the last several decades have been the primary options, but we see growth in options that continue to gain steam. And that is, first off, and of the three, probably the least popular, but that is spinning off the back office, creating an MSO, and in essence, using that as a platform to grow and build a new book of business, which is in essence what private equity is doing to practices. So there's no reason why a practice can't do that themselves. But an option is to sell to private equity, whether that be becoming a platform that then is grown, or being a bolt-on to an existing platform, depending on the size and who the affiliating partner is. Those are options. And then clearly lots of options to sell to non-traditional healthcare providers. Where we see a lot of activity right now, the non-traditional healthcare provider space seems to be very, very important and focused on primary care. We see a lot of growth there. chasing, risk-based contracting, Medicare Advantage lives in order to turn those into greater value down the road. What has been interesting to see is how health systems are responding to those non-traditional healthcare provider offers, meaning these non-traditional healthcare providers are coming to the table with pretty significant purchase prices for these primary care practices, and health systems want to compete, yet they don't necessarily have the same value-based enterprise that the non-traditional healthcare providers have, and therefore the ability to take what a primary care practice may have and monetize that in terms of shifting towards risk-based contracting doesn't necessarily exist. And so the pace at which we've seen many health systems move into value-based reimbursement and true risk-based contracting, I think puts them at a disadvantage in terms of trying to compete with some of the non-traditional healthcare providers that are in the market. On the private equity side of the equation, it's been interesting to see how it has gained steam. We see a lot of activity there in the specialty care space. Yes, some private equity firms are focused on primary care, yet a lot of the focus is on various specialty care arrangements, whether that's orthopedics, ophthalmology, pain management, cardiology, and the list can go on. And there's a high level of attractiveness to private equity from a private medical group. The newness of it, the sexiness of it is attractive. I think the large upfront payment that often comes from selling to private equity is attractive as well. And so it is gaining momentum. What is interesting, though, is depending on the dynamics of those private medical groups, it is not a slam dunk in terms of convincing the group that private equity is the best option. What we see in many instances is a divide between how more senior, closer to retirement physicians react and respond to a potential private equity offer versus new physicians, those that are younger in their practice. The retiring physicians are very quick to want to move in that direction. The younger physicians who have a lot of practice ahead of them are a little bit more reserved as to whether this is the right fit for them. And so that creates this dynamic in the medical group that has to be worked through. And it's been interesting to watch some of those dynamics play out. As we think about some of the more traditional alignment options, a lot of options continue to exist for health systems and physician groups to work together. We've used this slide for a number of years, but I think it highlights well, what the limited integration, moderate integration, and full integration options are. I think as we think about alignment, some of those limited and moderate integration options tend to just occur now and are really not necessarily thought of as true alignment. A lot of the alignment focus is in that full integration bucket, and that's where the focus is. Yet we still see some activity in the moderate integration realm. Just this last week, I was working with a client who is contemplating how they react and respond to some of the changes with shared and split visit billing and how it may impact provider compensation. And the thought or what we were looking at is, can we either put in a co-management arrangement or use some of the value-based exceptions to pursue value-based activity that would then allow for some potential income repair associated with the impact of shared split visits. And so while a lot of the focus is in that full integration realm, there's still options or opportunities to utilize limited and moderate integration alignment options to meet key needs of organizations. So focusing on private equity for just a moment, this chart is showing how private equity transactions have ebbed and flowed over time. We can see a large spike in 2021, and then as the overall economic market or economic landscape softened, we saw a drop in deals in 2022. As you can note over on the far right, 2023 is expected to be the year of the add-on deal. What we see is there's a lot of capital available still in the market, dry powder as it is oftentimes referred to. Yet due to the fact that most private equity firms want to leverage the deals, meaning finance a good chunk of it through debt financing, because of the current market from a debt financing standpoint, that doesn't it's not as palatable with where interest rates sit. And so the idea is, can we use some of that that dry powder, that capital that we have on hand, to do bolt-ons or add-ons to the platforms that we've already established, as opposed to going out and doing more true platform deals that require more capital spend and typically would be financed with some debt financing. And so we see 2023 being ripe for those smaller, high quality deals that can largely be financed with the capital available, as opposed to debt financing. You know, why PE firms invest in physician practices and why practices are motivated to sell. You know, to address the first point, I think there's a lot of opportunity seen in consolidating physician practices, whether that be pursuing economies of scale, or whether it is pursuing some of the changes going on in the market as to relaxing CON laws in certain states, as well as Medicare's push to do more in the ambulatory setting. I think there's opportunity seen in those realms. You know, when we look at practices, I think they see the same need to align, whether it be with private equity or a hospital, and that is driving the decision to move in a direction. And so the motivation to align with private equity is really no different than the motivation to align with a hospital. Yet why they end up choosing one versus the other, I think, can be impacted by the deal terms and what the future aspirations or motivations of the group may be. You know, the potential impact of private equity, I think, is oftentimes a question, meaning what impact is it having on practices, on the healthcare industry? I think it goes without saying, private equity has a profit motive, and therefore they are going to seek a profit motive in their deals. And I think that will come through cost cutting, meaning, you know, where can we do more with less? You know, are there opportunities to use advanced practice providers in lieu of physicians, or can we complement what the physicians are doing and get more profit opportunities through supplementing them with APPs? One of the things that we see, and we do a good bit of work in, is the increased risk for fraud and abuse in the private equity realm, meaning a lot of the private equity firms may not necessarily have a strong track record in healthcare. As we all know, healthcare has a lot of nuance that may not be appreciated. And so there's an opportunity or a risk of fraud and abuse issues unknowingly, just because the rules of the road are not known. And so where we've been able to support private equity firms is doing ongoing compliance officer work, whether that is training or being fractional compliance officers for platform companies, to make sure that they understand what is needed and expected of them and can push in that direction. We do continue to see growth from a regulatory standpoint in terms of the scrutiny on private equity deals, and you know, whether it is the president or the FTC or Congress questioning the impact of private equity on healthcare, meaning, is it actually increasing quality and lowering costs, or is it having the opposite effect? And I think we're going to continue to see more focus there. We've seen some OIG investigations specifically focused on private equity firms over the last number of years, and I think that likely will continue to occur. And there's been quite a few naysayers on the impact of private equity in healthcare. You can see a few quotes here, private equity being fundamentally incompatible with sound healthcare that serves patients. P's focus on short-term revenue generation and consolidation undermines competition and destabilizes healthcare markets. So I think there's some pretty strong views, both for and against private equity's impact on healthcare. Yet, regardless of the views, I think it is here to stay for the foreseeable future. And one of the things that we highlight, especially as we're working with health system clients and physician groups who are contemplating private equity deals, is not to necessarily lean them in one direction or another, but to help them understand, the pros and cons of private equity. And some of the things that may lean in favor of health systems are what you see on this slide, meaning private equity firms are oftentimes not tied with the local community like a health system may be. Private equity firms, in most cases, are seeking that second sale or the second bite of the apple, and therefore there may be a lack of clarity as to who that eventual employer or owner may be. And you compare that to a hospital, we know who the hospital is going to be. We may not know who the CEO or the leadership team may be, but there is a higher level of stability in terms of ownership relative to health systems. I won't go through each of these, but I think there are dynamics that need to be thought of as health systems choose, as practices choose who they align with. And as I mentioned, the age of physicians, I think, has a huge impact on the attractiveness of private equity. And so as we think about independent physician enterprises, key challenges, anytime alignment is sought, it creates a loss of autonomy. And that is something that independent physician enterprises hold dear to them. In many instances, that governance and autonomy may actually outweigh their desire for better economics. I think anytime a physician enterprise approaches a deal, there's a lot of focus on unwind and the desire to be able to unwind if the need arises. I think the reality is that we can negotiate unwind provisions, but any alignment deal is truly difficult to unwind. And there's going to be capital involved to try to reset the group. One of the things that I've had conversations on over the last couple of days is the private equity impact on cardiology. And the unique dynamic with cardiology right now is the majority of cardiologists, I think 85% or so, are employed by health systems. And so if private equity actually wants to get into cardiology, some of that critical mass has to come from health systems. And if a cardiology group actually has an interest in shifting in that direction, the question is how truly functional is it to unwind themselves from that health system, and what impact may that have on prospective deal terms? Potential opportunities, oftentimes there is a payout, and whether that payout comes in the form of a private equity deal with more money up front and potentially less over time, or if it is more so the traditional hospital deal where there's less upfront money and more in terms of ongoing compensation as market-based wages are sought. I think either approach is intended to provide some uptick in economics. Stability and a shifting of risk is also sought and oftentimes accomplished in an alignment. And so there are truly benefits to physician enterprises to align, yet they have to weigh those benefits with some of the challenges or risks that come alongside them. And as we shift and sort of look at the third bucket, that is current hospital-affiliated physician enterprises. And I won't focus on sort of legacy options here, because in essence, the legacy options have led to the alignment that exists today. And so as we think about hospital affiliated physician enterprises in the context of some of the economic challenges that we've talked about, I think there are options that these physician enterprises have to pursue. I think the first is value creation, meaning, as I said earlier, we've created the critical mass. Now, what do we do with it? I think the next is a repeat of what we've seen or what we saw in the 1990s, meaning if there is a scarcity of resources, does that require us to rethink who we employ and why we employ who we employ? And I do think we will see some of that. In fact, in certain instances, I think we've already seen some of that. And then finally, I think there will be a growing number of options for health systems to affiliate with non-traditional healthcare providers, meaning if a disruptor is really good at pursuing risk and creating value in the primary care space and a health system is not, are there opportunities for those two parties to partner together and create value accordingly? As we look at employment, as has been mentioned, market share is oftentimes the focus, and physician employment is pursued because it is to some extent easier. It allows for full integration. It provides a higher level of control than other alignment options. And that is why we see the growth in employment that we have seen. And so we've seen this growth. And now the question is truly, what do we do with it? Meaning the critical mass alone is not going to be enough. We've got to find a way to truly measure and report to the overall health system the value that is being created by the physician enterprise. And if I just highlight this slide, the physician enterprise return on investment, I think it gets into that value creation focal point. And this is where we see a core focus right now by many physician enterprises, meaning we're seeking returns. We want to be able to justify the critical mass that we've created. We want to be able to demonstrate how it is creating value for the overall health system. And what we've seen to date, there's been a lot of focus on the loss or the investment per physician, which is a lot of red. And we've seen most health systems in the past be okay with the investment in the physician enterprise so long as the economics of the entire health system are functioning appropriately. But as we've seen the overall health system economics diminish, that has put more focus, a brighter spotlight on the physician enterprise and the investment per physician there. And one of our contentions is, just looking at it in terms of the investment or the loss per physician doesn't always give you the answer that you need. First off, there's really not great benchmark data to compare to, or compare the loss per physician to. And a lot of that comes into, how we think about costs and what we're actually allocating to the physician enterprise versus what may be in benchmark data. We've worked with a number of organizations who, felt pretty darn good about their investment per physician, only for us to point out that, they're really not pushing down fully loaded cost in terms of, occupancy costs and, some of the health system leadership costs to reflect a fully loaded income statement. And so, in some instances that comfort level with the current investment is misplaced because of an apples to oranges comparison. And so one of the things that we're working with health systems to do is rethink how we measure or how we think about that return on investment. And are there other metrics that we can look at that truly demonstrate the value to the overall organization, both at the specialty level as well as the physician enterprise level to answer those value questions, but then also use that as a guide to directionally how we make decisions going forward. And then as we think about how we actually create value, there's really external focus and internal focus. First off is how do we have a greater impact on the market through our market strategy and enhancing our referral network, growing in population health, and trying to address or mitigate some of the competitive pressures. But then internally, how do we truly think about expense reduction and revenue enhancement and make sure that we are truly delivering as much value as possible. And oftentimes, where we get involved in some of that financial and operational performance improvement is either on the revenue cycle side or the provider compensation side, because those tend to be the two largest single line items in the physician enterprise. I was at a conference the other day, and a vice president of provider compensation indicated that they are controlling or managing roughly a billion with a B dollars of spend in the organization tied to provider compensation. And I think it just highlights the impact, both the costs tied up in provider compensation and the potential impact you have there, but also how those funds are deployed likely has a greater impact on the overall performance of the organization than some of the other large line items in the health system. And so we continue to see focus in this space. I think we will continue to see organizations seeking a return, and the focus will be on value creation versus simply critical mass creation. So challenges, as I've stated, growing financial pressures are shining that light on the historical investment. We've got to find a way to create a return. And due to hospital affiliation, sometimes there are resource limitations and the inability to be nimble with changes in the market. We see that as highlighted earlier with value-based reimbursement. The disruptors in the market have gotten way ahead of most health systems in terms of their ability to manage risk and have an impact in that realm. Opportunities, I do think there are opportunities to partner with non-traditional healthcare providers. And as we wrap up here over the next few minutes, I think we'll see some of those illustrations. I also think that there may be some specialties that we've chosen to employ that we don't need to. And I think there may be ways to approach alignment that rebalances the risk profile that we've inherited to date. And I do think as health systems try to compete with some of the things going on in the market, they can pursue private equity-like models and make sure that they are on a competitive footing with what private equity is doing. I know a health system who is seeing a lot of pressure in the orthopedic space is rethinking their ambulatory ASC strategy in terms of how they partnered with physicians in that space, because they know it's a way that they can be more competitive compared to some of the options out there in the private equity landscape. And so I think these adaptations of how health systems have historically thought about things will continue to occur and further evolve as time goes by. And so as we get close to wrapping up today, I thought I would just spend a little bit of time looking at the future impact within the healthcare industry and where I see some things going. And once again, try to do this not through me just talking, but more so looking at some of the headlines and some of the things that we're seeing going on in the markets. The first thing I'll highlight is an article from a recent Fierce Healthcare report. Spoke to the fact that retailers, payers, and startups could capture 30% of the primary care market by 2030, which I think is pretty striking, but it shows how much focus there is on the primary care space by non-hospital and health system entities. And so if we truly think about them capturing 30% of the market, it is going to have ripple effects through the entire healthcare industry. I've mentioned some of the disruptors that are in the market. I think VillageMD, Privia, and Oak Street Health, specifically primarily in the primary care space, are continuing to have an impact. I think they will continue to have that impact as they evolve. But then we continue to see more in the way of collaborations. Just to highlight some of the things that we've seen over the last number of months, Privia Health and Novant formed a strategic partnership that's really focused on the creation of a clinically integrated network that can apply to both community physicians and provider groups. And it will provide a number of population health tools that hopefully will start to impact how care is delivered, creating success in that clinically integrated network. We see Advocate Aurora and Oak Street Health partnering together on senior primary care. Once again, a focal point of a health system and a disruptor partnering together to affect care. I think in this instance, we will see more of this as health systems realize that there may be value in partnering with somebody who is specifically focused on risk-based contracting in primary care to have an impact. Highlighting another one, hospitals eyeing outside partnerships to counter disruptors, another example of how we see this market changing. And just to highlight a few more, CVS, once again, what used to be a drug store or primarily a pharmacy company, a neighborhood market type store, is now a major player in the healthcare space, partnering with Rush on a new ACO for patients in the Chicago area. I think we're going to continue to see more and more of this. And so just as a few concluding statements, and then I'll stay online for a moment or two to answer any questions that may come in. But as I've tried to highlight, the healthcare market continues to evolve. And as the healthcare market evolves, the alignment dynamics evolve alongside it. Physicians have more options than ever as relates to what they pursue. And I think the ball is very much in their court as to how they choose to practice medicine going forward. Private equity and non-traditional players continue to impact alignment and alignment models. I see that only growing in prominence as opportunity exists. And other dynamics that are affecting the current state are the health system pressures. I see most health systems not wanting to give up what they have created to date, and therefore they will be seeking value creation. And how do they, truly create value and demonstrate value for their physician or for their health system? And how do they adapt and handle the changing provider compensation dynamics where we have what typically occurs in supply and demand dynamics being at odds with the economic environment of health systems? And I see no reduction in the focus on pursuing value-based care. And we see the government encouraging it through the most recent value-based exceptions. We see these disruptors and other non-traditional providers pursuing it. And I think that will continue to have an impact on the market and future alignment trends. And so with that, I'll pause and see if we have any questions that I can respond to. And if not, we can wrap up a couple minutes early. Yeah, so a question that popped up, what are some reasonable first steps for physician practice groups to pursue value-based contracting? I think it's a great question, and I think it somewhat depends on the specialty that you are in. I think oftentimes we see, physician enterprises feel the pressure to do something in the value-based realm simply because it's what all the talk is in the market. And I think the first thing that we would always recommend is looking at two things. Number one, what are payers, commercial payers doing in your specific market? Because every market is different, but what are commercial payers doing in your specific market? And number two, what opportunities are availed in terms of governmental programs that you could potentially pursue? And I think those two should set the stage for potential opportunities. Obviously, every physician group has some opportunity in the Medicare realm, which can drive some opportunities in different markets. Sometimes commercial payers are very active, other times they're not. And so I think that will heavily impact what you can do there. But I think it's seeing what the payers are giving you the opportunity to pursue, and then building a plan around that. Another question that popped in: do you see the outlook for PE-backed activity for physicians to continue medium and long term? So I see no slowdown in the PE-backed activity. I think it will continue to occur. I think these specialties of focus will continue to change and evolve as the market changes and evolves. I think one of the more interesting spaces, as I mentioned previously, is cardiology. You know, it is not a space that I would typically think private equity would have a focal point, given the high concentration of employment and the fact that, you know, we have not seen this shift just yet of doing things in the ambulatory setting. But I do think with the growing baby boomer population, with the contemplated relaxation of CON laws in a number of states, and the opportunity to potentially start doing more interventional procedures in outpatient settings, I think it's ripe for growth in the PE space. Meaning, they see that growth in demand and the opportunity to capitalize on ancillary activities, and now it's just a matter of how do we get the physicians to drive it. A couple other questions as I'm just assessing what's coming in. Any comments on state regulatory efforts to oversee private equity participation in the healthcare markets? I don't have any specific comments on state regulatory efforts, but I do know there is a growing focus on the impact on private equity, you know, at the presidential level, in Congress, FTC, OIG. And so I do think we will continue to see regulatory scrutiny there. Whether they put holds on activity, I see that as being doubtful. Yet I think the pressure and focus from an antitrust standpoint and fraud and abuse standpoint will continue to increase. Are health plans considered private equity? Health plans acquiring or opening healthcare clinics? I don't necessarily view health plans as private equity, but I do think we continue to see insurers playing a role in the physician roll-up. You know, the one being most predominant is United Healthcare. I mean, I saw a stat, and I can't remember what it is, so I won't try to quote it, but the number of physicians that they currently employ through Optum Medical Group is astounding. And so I do think we will continue to see health plans competing with the disruptors and hospitals to create additional integration. Let's see if there's any others. Got a physician who asked a question. He says, I'm a physician, and a critical consideration is the issue of control in making decision to sell to PE or other arrangements where control is limited or lost. And I think that's getting to governance. And, you know, anytime we see a provider group contemplating alignment, there's three key things that are typically a focus: governance, control, economics, and the ability to unwind. I would say the majority of conversation tends to live on in those realms. And I think anytime that you are aligning with a partner and selling the majority of your entity to that partner, I think you have to appreciate the fact that you will not be the primary decision maker going forward. I think you can work governance provisions to where you have a say in key decisions, yet I think with a sale, there has to be some expectation that there will be a loss in autonomy. And so how you navigate that, how you set up sort of a prospective governance matrix as to, you know, what day-to-day decisions can you control, you know, what can be controlled by a majority of vote, which would typically be the owner, and then what decisions require a supermajority vote, which presumably would be both parties having to vote in alignment, I think is key to work out and make sure is defined prior to entering the transaction. So I think we're about out of time, and I think I addressed the majority of questions. If I did not, feel free to reach out. after the fact. Very much appreciate those who chose to participate. Hopefully there's a few nuggets of information that are helpful in your pathway, and have a great rest of the day. Thanks so much.
Thank you, Justin, and thank you to Coker Group for this presentation today. This concludes today's program. Thank you all for joining. The live webinar will be disconnected now.